Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, January 17, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And if you date back to yesterday, we talked about the down day we had, and we also talked about the fact that if I was going to classify yesterday as a reversal day, I would have liked to seen the day close below the prior day's low. So the prior day to yesterday was the 12th, and the low was 276.08. Yesterday we came up just short of that on the lows, but we didn't close below that low for sure, and therefore I was reluctant to classify it as a reversal day. Today we had basically an entire take back of yesterday's down day. The market actually came up short of yesterday's high on today's high by just 4 cents before backing off into the closing bell. Or what was really about the last hour, hour and a half of trading. The market topped out, and then we saw some profit taking over the last hour to hour and a half of trading. One of the other reasons that a day like today takes place has to do with the fact that this week is options expiration week. Now think about this for a moment. Yesterday we had a decent down day, and there's a lot of traders and investors out there that are looking for a reason to go short the market. They think the market's way too high, and they know that if the market does begin a correction, it will come down hard and fast, and therefore they're trying to hop on anticipating a correction taking place. How many traders do you think hopped on the short side of the market yesterday, either with puts or some other form, whether it's a leveraged exchange-traded fund, shorting individual names, whatever it was? There certainly is a large swath of traders out there that shorted the market yesterday. We also discussed the fact that the options desks on the large institutional trading firms, for example, the large big investment banks, the commercial banks, the hedge funds, they have options desks. The people that work on the options desks make most of their money this week. It's options expiration week. The monthly options expiration happens this Friday. With a lot of puts bought yesterday, and think about this for a minute. If you're buying a put, there's somebody on the other side of the trade that sold that put. Likely, it's one of the institutional options desks or market makers, we're one and the same, that have sold a put against your purchase of the put. Therefore, you're on the other side of the trade as the institutions. You don't want to be on the other side of the trade from an institution. What happened today? They ripped the market back higher. A lot of short covering took place. A lot of people that bought puts yesterday sold them. They took the loss. They're out of the position. And guess what? The other side of that position was a moneymaker, the institutional options desks. Things like this happen over and over again during options expiration week, especially when there's a large down day or a large up day in the market. They usually take the market in the other direction in order to get paid on those trades that were taken by the retail trader. They're on the other side of that trade. So if a retail trader was buying a put, the person that sold that put to them is likely the options desk from the institutional side of the house. It's just that simple. Just like anybody else, they're not going to win 100% of the time, but they're going to win a lot more often than the retail trader will win. And that's why selling in the hole during options expiration week is not necessarily a good bet. What does that mean, selling in the hole? Well, let's go down to a 10-minute chart, and I'll explain exactly what I mean. So yesterday, a lot of puts were bought down in this zone here, near the lows of the day. That's just the way it works. That's where most of the retail traders decide that the market's rolling over, it's got a lot more downside coming, therefore they want to buy puts because they want to participate on the downside. So they're selling in the hole. In the hole means the market's already down, they're selling in the hole. Selling the market, that is, they're buying the put in the hole. And today it's obvious what you saw happen. The market was basically a straight line up, and the put buyers were left holding the bag from about midday forward. Speaking of midday, that brings me to another point. I want to give a little chart lesson because something happened in the middle of the day that's very important, and it's something that I teach in my course at lazyemintrader.com. And it's very important because the market gave a tip-off this afternoon that it was not going to go lower, that it was going to continue higher. Doesn't happen 100% of the time, but it certainly gave the tip-off, and I want to explain what that is. I'll give you a little tidbit and a little chart lesson right out of my course at Lazy E-mini Trader. The best way to describe this is to look at a 60-minute chart. So I've flipped over to an hourly chart, and what I want to point out first is a breakdown candle. So this candle right here, this red candle is what I like to call a breakdown candle. A large red candle, I call them breakdown candles. Now, the market today could have easily just retraced a portion of yesterday's move, either went sideways or failed and went lower. But once the market closed on an hourly basis above the high of this breakdown candle, which was $278.39, once that took place, that was the tip-off that the market was not going to go back down, that it was likely going to go higher. Again, nothing works 100% of the time, but this certainly works the majority and large majority of the time. So here's what I mean. You see this candle here that closed at 11:30 a.m. It tested the high of that candle, but did not close above the high of that candle. So the high of this candle was 278.48. Remember, the high of this candle was 278.39. So we made a run for it, but it did not close above there. We closed at 278.27. So there was still a chance at the 11:30 hour that the market was just going to roll over again, and all it was going to have done was make a retrace of yesterday's down move. That's natural. That's the way markets work. Happens all the time. Market goes down, retraces a portion of the move, then it continues lower. The same thing happens on the flip side. Market goes up, retraces a portion of the move, and then it goes back higher. That's the way markets work. Some folks like to call them waves. There's a lot of different names and a lot of different descriptions for what that is. Any way you want to look at it, the market will typically retrace a portion of a move and then continue on in that direction. Well, when the market closed above the high of this red candle, remember, 278.39, that occurred on the 12:30 candle. That's the candle that closed at 12:30 in the afternoon. The close was 278.64. As soon as that took place, that was the market's way of tipping its hand that it was not going to roll over and continue in the downward direction, that it was not a garden variety retracement. Didn't necessarily tell us that we were going to challenge the highs from yesterday, but it certainly told us that there was likely more upside coming. What happened? The market went in a straight line up for the next couple of hours before testing yesterday's highs and then backing off slightly in the last hour of trading. So if you just keep that little tidbit in your back pocket, it should serve you well over time. It's one of the ways the market tells us what its intentions are going forward. This works on a 10-minute chart. It works on an hourly chart, it works on a daily chart, it works on a weekly chart, and any chart in between. It works over and over and over again. Let's move over to the IWM, and we'll go back to the daily chart. And what you'll see here is the IWM just retraced a portion of the move from yesterday. Now, yesterday, we talked about the IWM, and I said it was a reversal day. So there is a divergence going on here right now. The S&P 500, in my opinion, didn't have a reversal day yesterday. The IWM, in my opinion, did have a reversal day yesterday, and we did not challenge the old highs today in the IWM like we did in the SPY or the S&P 500. So once again, we have a divergence. I'm paying attention to that because, as you know, the IWM or the Russell 2000 Index is my favorite market leading indicator. It generally gives me a pretty good signal of what's to come. So as far as I'm concerned, until and unless we close above yesterday's high in the IWM, this is a potential bearish wedge pattern that may play out, and it generally will play out to the downside. What I mean by that is, if you look at this down candle from yesterday, again, a breakdown candle, if we go sideways to higher or even just sideways for a few days, then the likely scenario is we'll have a down move, we'll have what's called a bearish wedge pattern, and that'll promote another down move. Will that happen? We're not 100% sure, but until and unless we close above yesterday's high, I know that that's a pattern that will likely be developing. If we close above yesterday's high, there is no pattern, and the market is free, or the IWM is free to continue higher. Which brings me to another chart lesson, or another trading lesson, I should say, and this one's pretty simple. When you take a trade, you always have to know where you're wrong in the trade. We like to lose small and fast if we have to lose. We know we're going to lose sometimes. Nobody wins 100% of the time. So the point is we want to lose small and fast if we have to lose. Therefore, in order to do that, you have to have a spot where you know that you're wrong on a trade. And this is one of the other important things that I discuss in my course at Lazy E-mini Trader. How to identify on a various array of different chart patterns. So here's one, for example, where we know we would be wrong if, in fact, we were taking a trade on the short side in the IWM right now. I'm not suggesting you do that. I'm just saying if we were, we know where we're wrong with a daily close above yesterday's high. It's as simple as that. So you take a trade, we're short the market. If, in fact, we were to close tomorrow or the following day or sometime next week above yesterday's high, then we have to move out of the trade. We have to close the position because that's the market's way of telling us that it's likely going higher and that we were wrong on the trade. So based on the type of chart pattern, there's different areas and different reasons how we know where we're wrong on a trade, but this is just one of them, and they're taught in my course at LazyEminiTrader.com. Keeping our losses to a bare minimum is one of the untold secrets in this business. It sounds very simple. However, most people, most traders don't do it. They end up taking a trade, they're out of the money on the trade, and they let it go against them far too long for far too much money in the hole. And they end up taking that one big loss that wipes out 5 winners at once. And you know exactly what I'm talking about. We've all done it at some point in time. The key is not to do it and to learn from our mistakes. Let's move along. We'll talk about the transports. The transports had somewhat of a meager rally today in comparison to the S&P, and the IWM had a nice up day. It just had a huge down day yesterday. Obviously, the Dow had a tremendous day, up 322 points, and the Nasdaq was also up over 1%. The Nasdaq Composite was up almost 75 points at about 1%. So the markets had a nice lift today, but the transports did not really have that great of a rally. So if we're going to say that yesterday was a reversal day in the transports, and it classifies as a reversal day, we'll see whether this puts in a bearish pattern similar to the one I just described in the IWM or not. But we know from a very long-term perspective, this is in a very strong uptrend, and there's a lot of runway where the Dow Jones Transportation Average can actually come down to work off some of the overbought condition and correct itself. There's a lot of runway it has to do that and still remain in an uptrend. In fact, it really needs to come down and work off some of this overbought condition in the transports. So I expect that to happen at a very bare minimum, to go sideways for a while, eat some time off the clock, and let the moving averages, namely the 20 moving average, come back up to meet price, or at least come close to price. Flip over to the gold market. You can see here that we did finally have what I thought would be resistance. We ended up going up to 1345 in gold. I said 1338 to 1340. So we went about $5 on an overshoot of what I thought would be resistance. However, you can see here that we're having a nice down day today. We're down at 1327 in the gold market. I think there's likely some more downside coming in gold. The likely scenario is that we do find some support at a bare minimum, even intraday support, down here at 1320, which is the low of this last green up candle. That will be a natural area where gold will find at minimum of some intraday support, right down in this area here. If we bust through there and we begin closing hourly below that area, your next natural area of support is right down here around 1310 to 1305, where you have the 20-period moving average. This right here will be another area which will also be very good support for the gold market. I do contend that gold will come down as it's also in an overbought condition. Nobody should be surprised that we found resistance up here at the 1338 to 1340 area. You'll also notice what kind of candle yesterday's wound up to be. This is a doji candle. That's generally, and this is also taught in my course at Lazy E Mini Trader, that's generally a signal. It's the market's way of tipping its hand that it's a signal of a change in trend ahead, especially when those occur at near-term highs and lows on charts. Yesterday would classify as a near-term high on the chart. By the way, these little tiny chart lessons I'm giving you here, I've given you 2 or 3 today. Obviously, there's a lot more in my course, but this is also the same exact information that I use to determine a swing trade. As most of you know, I'm coming out with a swing trading service, hopefully within a week or so. And the bottom line is all the strategies, everything that I'm going to use to determine swing trades, whether they're long trades or whether they're short trades, everything is taught in my course at Lazy E Mini Trader. There's no secrets. There's no information that's withheld. If you want to learn everything that I know, then you can learn it in the course and you'll be able to understand where the highest probability directional moves are in any market on any chart. I've really put together a pretty good and healthy library of information that can benefit you for the rest or the entirety of your trading career. All right, enough with the commercial. We'll go on to the crude oil market. And crude was up a little bit today. It was down a little bit yesterday. As you can see, what we're really doing here so far is just going sideways. And you can see the 20 moving average continues to creep up towards price. This was an overbought condition. And what we're doing is what I've talked about in the other markets that's necessary is we're just going sideways. Maybe we go back and forth for a while. Maybe the 20-period moving average comes up some more, works off some of the overbought condition, and then the market will be free to move higher. This isn't an uptrend, and there are higher prices likely in the crude oil market. Even if we came down a little bit to work off some of the overbought condition, that's not going to damage the uptrend in crude oil until and unless we begin closing below certain levels that we're nowhere near today. So we don't really even have to talk about them. Before we leave you tonight, I will give you one more piece of information, food for thought. So we're looking at a 10-minute chart now on crude oil. And what I want to point out is this pattern here, which is very similar to this pattern here, which is very similar to this pattern here, although they're different in terms of time, but they're the same look. Those are bullish patterns, and that's the market's way of telling us that it's likely headed higher. Now, this last one, you see this spike that happened out of this bullish pattern. Let's look at an hourly chart, and we'll see a little bit more of a tight pattern on the hourly chart. We had an up move, so we have this green up candle here, and then we had sideways consolidation for 4 or 5 hours, and then we had another up move. This happens on the charts over and over and over again in both directions. It's another one of the chart lessons that's taught in my course. I'm sorry about the commercial. But what's important to realize is if you're looking to take a position, what I describe to you is where to take the position and where you're wrong on the trade. Those are the 2 important things that make up successful trades. You want to get the best price, and you want to know when to cut and run, when you have to cut and run, because the chart is telling you something different than it was before. And I think we're going to give it a wrap there tonight. So it's everything I wanted to, and probably a little bit more than I intended to discuss tonight, but so be it. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.